Hello, friends. Today's topic on this special episode is about human behavior and how we behave when the market is not in our favor. So, this example in front of you is that of very recent post election day results. If you recall, on the previous day, there was a huge gap up basis the exit polls where the numbers expected were very high. And next day, as the election results were getting counted, the outcome of it was lower than expectation. And in general, the market was panicking that maybe the current coalition may fail and some uncertainty may come in the market. And the market actually fell from 23,200 open to nearly 21,300 at the bottom. And all this happened within 4 hours of the market opening. So almost 2,000 points were lost, which is nearly 8 or 9% of the market cap. India's market cap is somewhere closer to 5 lakh crores or 4 lakh crores. So a huge kind of a cut was delivered on that day. Now, the question to be asked is, if you are a longer term investor, did you panic on this day? Uh, I would imagine that most shorter term players, maybe somebody who would have built overnight positions here or even here, would be the hardest hit because, on leverage, especially if you have options or if you are trading futures on leverage, even if 8% kind of fall can really demolish your base of capital. Uh, for others, it was a matter of how they perceive the markets, in the sense that those who are seasoned in the markets know that these falls are not permanent. Those who have confidence that the India story is on know that this cannot last for too long. Those that have borne these kind of hits many times in the past, of course, there is you can't say that a 8 or 10% fall is a happy day for anybody. It is discomforting to see your capital erode, but the idea here is that when you are going up and you have been going up for so long, to expect that the market will never fall is you are living in a dreamland. If you don't expect that after going up, let's say 100%, market will not even correct 20 or 30%. So from pre-COVID, let's say January 2020, let's say till now, so 4.5 years, Nifty was 12,000 at that time. We are nearly 23, 24,000 now. So Nifty has doubled in 4 years, which if you see comes use the magic formula of 72, so it will come to about 18% CAGR, which is phenomenal for the equity market, for the index to grow that much with encompassing a COVID fall in that, where entire businesses were disrupted, entire demand cycle was disrupted. Despite that, a 18% CAGR in 4 years, and just a 8 or 10% fall beyond that. So the context of the fall is very important here. The fall was steep, no doubt about it, 8.6%. It engulfed the entire gain that was made from the beginning of the calendar year. Although from November, we had already gone up from 18,000 or let's say 19,000 till 23,200. So almost a 20% gain had already come, and we retraced about 40 to 50% of that uh, range. Now, did we stay patient during this fall? You need to ask yourself, what did you do on that day? Did you buy more? Did you sell out in panic? Did you think that, market will come down to 18,900, I will buy again, and you sold off here? All those questions you need to answer, and you can write in the comments how you behaved. Actually, on that topic, I also want to tell you that, especially in trading, a lot of good traders write down their emotions on a daily basis in their diaries, and investors can do that also over a period of time. Every month, every 2 weeks, you can maintain a diary which in which you can write that this is what the market was doing and this is what I was feeling and hence I did this. When you will have a compilation of that over a period of time, you will be able to see how many of your decisions went right, how many went wrong, and you will be able to build your decision making better when you will read your own chronicle of your journal, that yes, I was panicking in by mistake or by fear, and then over a period of time I am improving on that. So having that thought process of what was happening in your mind at that point of time, if you ask me, I was a bit taken aback by, because there was no expectation of such a fall. But did I do any transaction? No, because I am extremely you can say stubborn, that I will not break my rules. If my rules say that I am going to wait till the end of the week for any transaction to happen to see what is the net impact, it's fine. I mean, we've made so much money in the last 8 years in the markets. You have to give room to the market to play out its journey, especially when we have such a strong story going. And this is exactly what happened. Of course, this is all hindsight and we can say it today, but the fact remains that within 3 sessions, the market recovered the entire fall and everybody was stunned. What has happened? Because even after the fall, and the market recovered on this day to a certain extent, there was no expectation in the next 3 days you will come back here. There was expectation that maybe market will consolidate here. If I go back and see my videos on that day, I probably was expecting this to happen here. Even if there was no fall, to consolidate here, I was not expecting at all that a v-shaped sharp v-shaped recovery could have happened despite that result. And that recovery actually gives you a lot of confidence that all weak hands were shaken off that day. And after a few days of further disbelief about this, then the market really have started going into a new trajectory post that. So 5% fall have happened many times in the past. So let's now study the falls that have happened. And the study is basically from previous day close to the next day. What is the uh, 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 how many number of times have we fallen? Let's say 5%, and what is the subsequent recovery period? So this is the chart of all 5% fall periods, and you can see that 2 decades ago in 2000 2001 you had a lot of 5% fall days. In 2000, then the rally started 2003 till 2007, where you got only very few, like 4 sessions of 5% down days. And then once the GFC year came around, you had multiple, I mean, you have 6 here and another 8 here, 14 such 5% shocker days within a span of 1 year. This has never been achieved in the past in any fall. Always falls are there, then there's bounce, there's falls are there, and then there's bounce. But here you almost had one significant down day more than once a month virtually. And then the recovery rally started, where you had one such down day, and then from 2009 till 2015, no such day. You had one here, and then again during COVID, you had extreme volatility, 4 5 days of down days, and then post COVID, you had one day where you had more than 5% day. So uh, the significant falls in the market have virtually stopped since the last 4 years. You can see that since COVID, there was no day where you actually fell down 5%. And hence, people become very sanguine about the markets never falling. Although the nature of the market usually is such that, if you have a hard rally, there can be a hard fall also. But 2 steps forward, 1 step back, that is the nature of the market. Days to recover now. So again, the plotting is that of how many days were required to recover from that fall, right? So now in earlier years, it was between few days to, let's say, about 3 months, and then in 2008 it became extremely long to recover from where the highest recovery. So for the first 5% fall of 2008, it took almost 648 days to recover from that. But then post 2008, you only had, yeah, sorry, this was January, and then in October 2008, you had a 144 days to recover, and then you had 211 days to recover in the August 15th fall. And post that, even the COVID falls were extremely fast to recover. I mean, the maximum was 68 days, which is nothing really. I mean, if you are making so much returns, better than the normal returns, but then on the give back side, you're only spending 68 days in a drawdown. That is nothing actually. I mean, so from a perspective of how the market used to be, the market nature has changed dramatically in the last many years. So the domestic funds have strengthened the market. Earlier, only the FII movements used to cause the ups and downs, but now there is a counterbalance that from the first 12 years in this study, there was 25 instances of 5% fall days, but in the next 8 years, we've had only 7 instances of fall days, and they're too concentrated in the COVID falls. The recoveries also have been extremely fast. In the last 4 years, since let's say mid of 2020, you've had just two. In fact, since 2020 July, last 4 years have been only one instance. But if you include COVID, you also had 68 days of recovery from there. So a lot of local money is driving the recovery, which is coming very quickly. The stabilization of local money versus FII money has happened. The balancing act has happened, and I was reading some report where the domestic ownership of stocks is actually crossing the institutional domestic ownership of stocks, and retail is actually crossing the FII holding of stocks. So the elephant in the room, which used to be the FII position, is no longer there. And also, fund managers are investing substantial equity funds into the markets. They cannot help it because there is so much of fund which is coming in. Let's say you are a fund manager and you've done well. I mean, the market has done well, so maybe you have also done well. Now, money is pouring into your fund. The SEBI rule says that you cannot keep more than 15% cash in your fund. So now the money is coming in. Either you close your fund that I don't want to accept more money, but this industry is basically all about accumulating AUM, because once you accumulate AUM, it is sticky, it doesn't go away, and you're able to make margins on it. So if you are making, let's say, 0.5% margin on a 40,000 crore AUM, you make 200 crores every year doing, even if your performance is not so good, or if it is so good, doesn't matter. So essentially, it is a great business to be in, and that is why a lot of folks are there. Now coming back, so regardless of market conditions, a lot of folks will remain in the market, and that is good actually. You need not run away from the market. Now it becomes like a virtuous cycle. So there is a liquidity cycle that happens, that more money comes in, fund manager has to invest. When he invests, let's say a fund manager is investing in, just for simplicity's sake, let's say all fund managers invest only in the index. Okay, they're all index mutual funds. Now what will happen? Money comes to the fund. The fund manager has to invest. When the fund manager invests in all Nifty stocks, Nifty rises. It attracts more investments. More investments come into the fund. More Nifty rises, and then there is some trigger which causes some 5% kind of fall, because a lot of people get nervous for no reason, and they say, okay, I've had enough. Or maybe some people get very easily satisfied. Somebody who makes, let's say, 20% in a year says, I've had enough, let me sell. There could be significant bunch of those people, and they all, when they combine using some trigger of some news, uh, it becomes a waterfall event. And then, because there's a lot of money also sitting on the sideline, there's ample liquidity in the system, there's these sharp corrections get bought into, and suddenly there is a lift up again. So it is like a virtuous cycle. Especially the passive funds, they keep pouring into passive funds, and those indices keep rising, that attracts more and more fund. So currently now the market sentiment is very positive. Any sharp fall is now bought into very quickly, uh, and significant falls are, quickly the recovery comes. So I think people have forgotten what is a bear market. The bears have all gone into extinction, probably to Siberia, and you can't find. I mean, earlier, I mean, if you asked me 10 years back, bears used to be like a significant force in the market, always looking for opportunity, and they used to make huge killing whenever these kind of falls were happening. But now they have been sent back into their holes, and any attempt by a bear is failing, especially in the last decade. And this is not just India phenomena; it is happening the world over. So this recovery, fast recovery, is enabled by huge liquidity in the system. I mean, as you may have already read, that in the last 10 years, the kind of liquidity central banks have brought into the system, led by the US Fed, the number of dollars in existence today is probably 70 or 80% of that has been just the last decade. The previous 100 years was only 20% of the capital, and 80% has been created in just the last decade. So there's so much liquidity that has been pumped into the system to just keep the system alive. Otherwise, it would have just gone into a depression. And that is why, at any point of time, when earlier all assets never used to rise together. So if in an Indian context also, if you are a 30, 40, 45-year old, you would remember that gold, real estate, and stock markets never used to rise in unison. It always used to be, if stock market is rising, real estate is falling. If real estate is rising, gold price is falling. These were all inverse correlations. Now everything is rising because liquidity is lifting up all the boats, and that liquidity cannot just go away. It is basically, the value of money is dying, and money will slosh from one asset class to the other wherever it sees more opportunity. So, it's just like a lot of water has been put into a pool, and now that water cannot go anywhere, it will just splash around. It's a bad analogy, but that's how it is. Then there will come a time, hopefully, probably, where markets may come back to some normalcy. What we are witnessing right now is not a normal market. Let it be very clear that this is not what a normal market does, that just goes in one way higher. Of course, we are all benefiting from it. I am not complaining about it. I'm just saying, don't think that the current market, the way it has been, is normal. This is not normal. This is actually abnormal. And normalcy is when there are periodic, it's market is like a pendulum. So it will go to one extreme, come back to normalcy, go to the other extreme, come back to normal, go to this extreme, come back to normal. Now what we are doing, we are just staying at one extreme. Just a little bit of coming back, and then we go back to the same extreme. We don't come to the normal, and we never go to the other side nowadays. So we need to go to that other side also sometimes, to to bring equilibrium, to make some sense. You probably read reports on how high valuations are of companies. So the valuation metrics has totally gone out of the window. What used to be a high valuation environment, let's say at 25 times market, now at 30, 35 times market also, people are saying, so what, the liquidity is there, there's no worry. So those kind of things are there, but in our mind, if we have made significant gains over a smaller period of time, we should always be ready for some declines, and for normalcy to come back. That is second nature of the market. And if it has not happened so far, don't expect that it will never happen. It's like, you're going on the road, and you have a flat tire. It will happen from time to time. I mean, to assume that I will never have a flat tire is sort of living in a very dream ideal kind of world. So the only way now then, going forward, is just ensure whenever there are sharp dips, either you use those dips to add more money to your strategies, rotate capital. After every such dip, you will find that a new sector kind of starts to go up. After every very long elongated fall, you will find that the previous winning sectors will never perform for the next many years. So all that requires that your strategy should be able to rotate into the new winners of the market. And if you do that, then there is no need to get out of the market at any point of time. Just stay with the market, make your money compound over time, and just enjoy this beautiful journey in the market. Please let me know in the comments how you like this content. What are your views about how you react to market falls, and share your knowledge with others in the comments. Also, I see a lot of people interacting with each other on different subjects of the topic, and this is very good interaction with other market players on your thought process. So do like and subscribe to our channel if you're watching it for the first time, and I'll see you in the next one. Thanks. Bye.